When a car battery dies, it stops being a power source and immediately becomes hazardous, lead-filled dead weight. In India alone, the rapidly expanding vehicle market generates roughly 4 to 5 million tons of this highly toxic battery waste every single year. Historically, a massive portion of that material vanished into the informal economy, broken down in inefficient, unsafe backyard operations that recovered only a fraction of the metal while polluting the surrounding soil. In Jaipur, Rajasthan, Gravita India treats this exact national waste stream as a perpetual source of industrial fuel. This strategy allows Gravita to compound capital at a staggering 24% return on invested capital, a figure they have sustained for a decade. They took a highly volatile environmental hazard and engineered it into one of the most reliable, high-yield financial engines in the industrial sector. Gravita avoids the massive capital risks of traditional mining and the instability of simple middleman trading. They operate a pure commodity spread business. The model starts by purchasing industrial waste, like discarded batteries or aluminum dross, at a steep discount compared to the value of the raw metal contained inside. Gravita then spends a fixed amount, roughly 15 to 20,000 rupees per ton, on smelting and refining to extract and purify that metal. They sell those newly purified alloys to top-tier manufacturers at full primary market prices. The gap that remains in the middle is their highly protected profit spread. This structural math shows up in the company's 10.6% EBITDA margin. While this appears low in isolation, Gravita's revenue includes the full market price of primary metals. In high-volume recycling, 10% is an optimal, healthy margin structure. Because their profit is locked entirely within that fixed processing gap, their earnings remain largely insulated from the wild, unpredictable swings of global metal prices. Gravita monetizes the industrialized capability to upgrade discounted garbage into premium commodities at scale. If the math of this arbitrage is that reliable, why haven't competitors simply replicated this strategy? The answer lies in the regulatory friction. Operating across more than 70 countries requires navigating a complex web of compliance laws, securing strict import licenses, and managing the international transport of hazardous materials. On the demand side, selling directly to giant automotive manufacturers requires strict product approvals. Earning OEM trust and passing technical audits takes years of execution. Gravita bypasses local supply constraints by using their overseas subsidiaries to procure cheap scrap globally, funneling that material into India for higher margin processing. They are now applying this heavily protected blueprint to entirely new materials, including aluminium, plastics, and rubber. They are aggressively expanding these growth vectors, acquiring RMIL to enter the copper market, and commissioning early-stage lithium-ion recycling plants to prepare for the electric vehicle transition. Gravita has engineered a scalable, multi-material circular economy platform protected by massive logistical walls. This infrastructure is perfectly positioned to capture a massive regulatory tailwind. New government extended producer responsibility norms now legally force major manufacturers to recycle their end-of-life products. These mandates are rapidly formalizing a previously fragmented shadow industry, driving predictable volumes of scrap directly into large-scale facilities like Gravita's. These tailwinds fuel the company's Vision 2030 target, scaling from their current 2.2 lakh tons to 8 lakh tons of total capacity. This creates a perpetual industrial cycle. Endless streams of urban decay are melted down and transformed back into pristine resources, ready to be deployed into the economy once more. The most defensible industrial returns of the next decade belong to companies that master the math of infinitely recycling the resources we have already extracted.